Liberty Street funds offer investors and financial advisors mutual funds sub-advised by independent boutique managers who possess expertise in their asset classes. And because Liberty Street focuses on the boutique managers, financial advisors can provide value-added strategies and actively managed, differentiated value-added portfolios for their clients. And with me is Munafo, the Chief Investment Officer and Portfolio Manager at Liberty Street Funds. So great to have you here.
Great to be here, Jane.
So let's start with just over the past couple of decades, these private markets have become really innovative, technologically disruptive in the marketplace. Explain what you're seeing there.
Yeah, so I think most of the technology and innovation historically we've seen has come from the private markets. So a lot of these companies tend to get started privately, they get financed privately, and as they scale, there's other access points for them to grow, either through public markets, sometimes they get acquired, sometimes buyout firms may take them over and inject additional capital. But there's been a really big development over the past couple of decades that as these companies are staying private for longer, it's requiring all different sorts of capital and liquidity solutions. 20 years ago, 25 years ago, your average venture-backed company would go public within about 4 years from inception, and the market caps were maybe around $500 million. Today, those same companies are staying private on average for at least 12 years, in some cases 15, 20 years, and as a result of that, they're growing into much larger market cap businesses inside the private market. There's a couple important takeaways from that. First, if you're a public market investor that doesn't have access to private market strategies, that means you're arguably missing out on a substantial amount of capital appreciation as these companies are scaling inside the private market, which many used to do historically inside the public market. Yeah. But the other takeaway is that as they're staying private for longer, those life cycles, those protracted life cycles can create friction inside the ecosystem. So your founder, employee, investor may not have the same timeline.
Interesting.
Right? And so as that's really developing and those companies stay private for longer, it creates friction inside the ecosystem, which sophisticated investors can sometimes take advantage of.
Yeah, so why are companies staying private longer? I remember, as you said, 20 years ago, it was all the excitement, let's do an IPO and go public. What kind of confluence of things happened that's forcing this to take place?
Yeah, there's three main reasons. So there's other reasons. We think the three main reasons are first, regulatory challenges and administrative burdens of being a public company have been a bit of a turnoff for a lot of groups, especially when they're not sitting on massive amounts of cash. It's expensive to be a public company. So one, I would say regulatory and administrative burdens. The second, when we look at the companies we focus on, which are these really high-profile private innovation companies, when you're trying to disrupt a sector or an industry, you may not want to be focused on hitting your next quarterly earnings by a penny.
I see.
Right? And so some of these companies would want to see their businesses grow and scale and further vet out their business models inside the private market to avoid unnecessary volatility. But perhaps the most important reason is the private market capital base has just expanded dramatically. When we look at the venture capital ecosystem, which we focus on, over the past 10 years alone, there's been over $1 trillion invested in this asset class, most of that towards the area we focus on, which is the later stage, which are companies that are typically doing hundreds of millions or billions. These are real businesses that 20, 25 years ago, they would have already been public.
Yeah, would have been public for a while probably at that
Correct.
point. And this does create inefficiencies in the market. They're not on the open market. You don't have all the market makers and the liquidity of things. So how is that helping or hurting what you do and what investors see?
Yeah, you nailed it. So there's no structural liquidity like we have with a ubiquitous exchange for public listed securities. And so in order for groups to achieve liquidity, you have to really understand the complex capital structures of the ecosystem, which is not, for the faint of heart. The good news is over the past couple of decades, there's also been the development of what we call the secondary market, where there's investors who allocate capital to help provide liquidity for participants in this private market ecosystem who need it. Whether you're a manager of a fund, a limited partner of a fund, or a portfolio company, or employee or investor within, there are increasing ways that investors can get liquidity, but because of the lack of ubiquitous exchange and illiquidity, groups can take advantage of those information asymmetries and price inefficiencies to really negotiate, in many situations, what can be favorable terms, where you can buy assets in the private market below their fair market value or their intrinsic value. And when you have periods like we have now, and we've had for the past 18 months, highly dislocated periods allow groups like us to negotiate even more favorable terms. So you have to be highly selective. We were talking earlier about interest rates.
Yeah.
This proliferation of longer 0% interest rates really created a lot of risk taking in the market, and we would argue a lot of companies and fund managers probably raised capital that wouldn't have if people were more disciplined, right? If there was a more rigorous diligence process. So there's going to be some pain. So the market's bifurcated, but we think that if you have a long-term perspective and you understand how private markets work, you can really optimize these conditions.
Yeah, and I'm also thinking about people who, there's a lot of upside that takes place in that private area
Right.
that you don't get in the public area. So this is depriving some people of those gains that aren't part of the original investment group.
Yeah, 100%. So we've done some analysis going back, roughly 15 years. And what we tried to do is see if we can empirically show how a private market investor in a venture-backed company that goes public compares to the public market investor who waits to access those companies at the IPO price if they're so fortunate to get that, which most cannot,
Right.
or the first trade. And what we've seen across a data set of roughly 800 tech-based companies that went public over this time period, the private market investor who just came into that last round, so not even at a discount to it or a prior round, they vastly outperform that public market investor. So Jane, to your point, we think that it's important for all investors, if they have an access desire for technology, innovation, and disruption, to increasingly look for ways to access them into the private market.
Yeah. How do you see the current market conditions then? And the rising interest rates, is that changing things for you? Will we start to see the IPO market be more active at some point in the future?
Interest rates are definitely having a ripple effect, we think, through the entire economy. The good thing for us about the venture ecosystem is these companies typically do not have debt. Quite frankly, many of them, most of them don't deserve it, right? These are not companies that are printing cash necessarily. And so you don't have that direct impact from the interest rates increasing, but you have indirect impacts because their underlying customers may be facing pressure, right? So they may be buying less widgets than they would have purchased in the past, or taking longer to make decisions. So you're seeing protracted sales cycles. And so ultimately that's impacting growth in some areas of the markets. So I think that's part of it. I think the good news is we are starting to see some green shoots. So we are seeing that companies are going out and raising capital. They're getting more conviction. We're seeing more capital being deployed by investors. There's still an imbalance. There's more companies seeking capital than there's capital willing to be committed to them at this point, but that's starting to loosen up. It's a fantastic time to be negotiating terms. So for capital deployment, we think this is a very attractive time to be investing. And we are starting to see the public markets open up a bit. I think, we have a long way to go here.
Yeah.
We had some companies get out. We think, quite frankly, there's better quality late-stage private companies that are pre-IPO, that are in the docket, that hopefully we'll see coming out over the coming quarters. But you really need to have a longer-term perspective when investing in private markets to benefit and access. And one of the things that we've tried to do, and you're seeing other groups do, is make private markets more investable. So you're seeing more innovative structures. We have a 1940 Act interval fund we're using that removes a lot of the inefficiencies and administrative burdens and high minimum investments, qualifications that typically are required. We've been doing that for about 10 years. So I think you're seeing more groups offer more solutions to broaden the access to alternatives in private markets. And we think overall that's a good thing for the ecosystem.
Very interesting. Christian, thank you so much for sharing your expertise.
It's a pleasure. Thanks, Jane.
Thanks.